So, Rick, the unemployment rate goes down, but a surprise contraction in jobs. Last time we spoke for last month, you said the employment picture is stable, broadly unimpressive. Has your assessment of this labor market changed since then with these numbers in hand?
No, broadly not impressive, I think is the right terminology. In fact, I was thinking about it. I think it's actually remarkable how unremarkable the data is. Listen, I think, when you look at, people say, well, gosh, we're not hiring many people because we have a supply issue. And you saw some of that play through today. But that being said, you're not seeing any wage growth. So meaning there's not that demand for labor that you would expect when you got an economy that's doing as well as it's doing. I mean, we're going to grow. I think you're going to see 6% nominal GDP. You've got corporate top line revenue that's strong. Earnings are strong. But you're seeing operating leverage for companies kick in like you read about. I mean, you look at all these earnings reports, particularly in the tech space. Companies are growing. They're spending immense amounts of CapEx. But you're actually cutting people in many cases. So anyway, I think we're seeing a productivity revolution, and I think we're watching it play out month in and month out. I mean, to have only 20,000 jobs on a 3-month moving average, you strip out healthcare, you're having negative job growth in aggregate. So anyway, I think listen, I just think we're going through. I think when they summarize this years from now, you're gonna witness something that is productivity. People say it's AI kicking in. I actually think it's just been an ethos around companies growing their business and seeing how you can operate without that much employment.
Well, also, you've got the fall in immigration that is probably contributing to these big declines we're seeing in the labor force. But the people who want jobs are apparently getting jobs with unemployment at 4.1%. So I assume this tells you, as well as the Fed, that we don't have a problem with the labor force side of the mandate.
Yeah, I mean, I think that's right, Mike. I mean, I've been pretty adamant about I don't think the Fed needs to hike, and I don't think you really will solve the inflation dynamic. Part of why I think these task forces will be so powerful is you'll get into what are some complex subjects. When you break down inflation today, you look at the difference between services and goods. You think about what's still sticky in inflation: education, healthcare, insurance. Because you're moving the overnight funds rate up really do much. And you get to the point being, if you're restrictive on rate and you're driving mortgage rates higher, I just don't see that as really effective trying to bring inflation down. You've got what I would argue is, yeah, maybe it's an okay labor market, but you still need, particularly when you have this much debt on the country, you need to grow faster. You need to put more people to work. And I think that, to me, is the philosophy that the Fed has to employ today.
Well, on the inflation side of things, Rick, I know you've been a big proponent. Again, the type of inflation we have isn't something that's fixed by hikes, but perhaps by policy, not monetary policy, but fiscal policy. Well, what is the policy you think that could start to eat away at inflation? Is it just like ending a war, basically?
I mean, listen, the war is a big deal. I mean, obviously, not only do you get higher prices in terms of fuel, but there's a transmission effect through that when you talk about, obviously, trade getting slowed somewhat. So anyway, the war is a big deal, obviously. So that will change. Then the dynamic, and people will focus on tariffs. The goods inflation, the U.S. economy is not that large of an importer of goods. So yes, and I think people got really worked up about that last year. So what do you do? And how do you create fiscal velocity? There's a bunch of things you could do. And I think, quite frankly, deregulation is powerful. I think the idea around how do you help with housing, things like zoning, permitting, et cetera. How do you get like some of the stuck student loan asset or liabilities on that young people have? How do you transition some of that? How do you help with some of that? I think there's a whole series of fiscal dynamics that can help with inflation, but I don't think moving the overnight funds rate will really do it. And we've seen that before. It doesn't really have that much of an impact.
I guess I would ask you then in that case, because I agree that there's probably not going to be anything happening on the fiscal side because they can't even vote on an attorney general at this point. And the Fed is maybe leaning now towards a hold in September. We'll see after the Wednesday CPI report. But that leaves us with an inertial economy. And what do you think happens to the economy if there's no movement on the fiscal or the monetary side?
Mike, I think you're unbelievably good at analyzing this, and I always appreciate the questions you ask at the FOMC meeting, et cetera. The only thing I will say is I'm not sure I agree with the inertial concept. I actually think the economy is operating at an amazingly strong level. And if you look at the CapEx, it's obviously a big driver of that from AI that's getting into straight growth of the economy in so many different forms. And then you look at consumption today. Consumption, you see this particularly in areas like leisure and hospitality. You see this in some of the transportation dynamics in terms of travel. Listen, the economy is operating, and actually the thing that was pretty amazing to me in the last 2 months is some of it had a fiscal tailwind, but the actually had lower and middle income that was actually starting to accelerate, and we see that in we use a lot of this high frequency data. You actually saw consumption in a pretty good place. So listen, I think the economy is operating at an extremely solid level. You would think in the second half of the year, you'd start to moderate a bit post the fiscal tailwind. But boy, you see this. I mean, this was a pretty amazing quarter of earnings reports that not pervasively across every single company or industry, but boy, I thought it was pretty darn good. And part of when you look at the equity market having a pretty good run, particularly recently, you're actually looking at multiples that are coming down because these companies are earning so fast. So anyway, I'm pretty enthusiastic about where the economy is today.
And I'm assuming that enthusiasm over equities translates into your world of credit, Rick. You have Bank, of course, a fund that has been outperforming the broader benchmark by a healthy clip for the past couple of years. I know last time you joined, you expressed skepticism on U.S. IG credit. You like carrying higher income. I think all of this is so interesting at a time, Rick, where, as you point out, so much is happening because of AI, especially in debt, with the huge issuance we're seeing from the hyperscalers. We got another $25 billion that this market easily took up from Google just this week. And at the same time, we're going to get more issuance from the Treasury next week. What are you thinking about where you want to place Bank, just given the sheer amount of issuance that continues to hit this market?
Danny, I would say one thing about, because you've had a backup in rates, you're able to hit your yield targets. I mean, talk about we're hitting almost 7. I mean, 6, high 6s in terms of yield. And so a couple of things we've been doing is you actually don't need to go down in credit quality. You don't need to go that far down in terms of the liquidity in the portfolio. So, we've been keeping it, we've been adding a bit in terms of European fixed income. I think emerging markets are interesting, particularly if you assume the dollar is not going to be moving aggressively. You made the point right. I think investment grade credit, given the amount of supply we're going to see, data center, hyperscaler, investment grade credit's not that interesting at all. But in the securitization market, they securitize assets both in commercial real estate, ABS, resi. Those markets are in pretty good shape. So, we're in an environment we don't feel like we got to stretch a lot. These real rates that today give us an amazing ability to keep our yield up without really stretching. We're running Bank now at an average rating of A-. You're hitting high 6s. Like, that's pretty good today. So I think we're trying to be in bonds. We're trying to be as boring as you could be, and take the risk in equities, which have a little bit of volatility to them, particularly single name.
A little bit less risk maybe in the bond market, but there's such an appetite, I guess I would say, for debt for the hyperscalers, et cetera. How's that affecting how you can sell all of these bonds? I was really surprised yesterday with the Google Alphabet offering that it was so oversubscribed.
Mike, we're living through something, and so one of the real benefits to all the financing that has to come, data center, hyperscaler, U.S. Treasury, UK, Japan, is we're actually going through a pretty historic demographic that is supporting this demand for yield, insurance companies, life insurance, pension. So it's amazing. If you price assets right on the debt side, you can place an awful lot of debt. Now, that being said, I mean, the hyperscalers have clearly widened quite a bit. And so you're getting the levels. Like I say, these real rates, if you're a pension today and think, gosh, I can defease a good portion of my liability stream at these real rates, it brings a lot of people in, particularly if you get some spread on it. And you're watching that play out. Like, I would say one thing, I mean, the supply is not going to stop coming. And, next week we get a lot of Treasury supply. So, in terms of interest rate exposure, we feel like we don't have to be in a rush to add much interest rate exposure and just like clip coupon.
All right, Rick, you're going to stick with us. We have to see how this market opens up and would love to get your commentary on a continued market reaction to this jobs report. We are back with BlackRock Chief Investment Officer of Global Fixed Income, Rick Rieder. Rick, okay, so this basically takes, in your view, a hike off the table. I wonder about cuts, though, because when we had spoken about a month ago, you said perhaps we still could get cuts in the back half of this year. Do you think that's still a possibility?
So, listen, I mean, you still have a Fed committee that is generally hawkish. You still have a committee that is more focused on inflation than the labor readings. So listen, I mean, I think it could still happen. You'd have to see some deceleration in economic conditions. You'd have to see, we think core PCE is going to come into the high twos, down to the high twos. Next year, we think you're going to get in the mid twos. Can you still get it done this year? I think so. But listen, I mean, I think you have to. One thing I've learned about investing, it's not what you, it's not what you think they should do. It's what they're going to do. And today, the structure of that committee clearly is we're going to fight inflation and use the rate tool to be that tool to get there. So, listen, I think they still could. I just think hiking doesn't make a lot of sense today.
Pre-interpret Wednesday for me, though, the CPI. We saw a big drop in market expectations, sort of a knee-jerk move after the labor report. What's it going to take to move one way or another in the fixed income markets on Wednesday with CPI?
Yeah, it's a great question, Mike. I mean, so, you've gotten a couple of softer prints on inflation recently. We think we're in this mode of getting 0.2s type of numbers when you look at core. And then, even, I was looking at the numbers for core PCE, maybe a little under the 0.2 monthly reading. So, listen, if you got something significantly aberrational to that, that would certainly move markets. Listen, if the number came in significantly higher, which would be incongruous with what you've seen over the last couple of months. Listen, is the Fed going to be on alert for that? Yes, I think so. You know it's better than anybody. I mean, I think this, what the chairman has stated, what Chairman Warsh has stated, is not just one number that he's laser focused on. He's looking at the panoply of readings, and our sense is inflation is slowly moderating. But it'll be interesting to see that report, like you said, that comes out Wednesday.
Rick, I do wonder, obviously yields are coming in now, but we have had a 30-year yield that has been stubborn and stubbornly moving higher above 5.2 at one point. Now it's obviously below 520. Do you think that this market is at all reflecting its concerns about credibility over the Fed and Chair Warsh?
I'm a little surprised at the concern around whether it was the last FOMC meeting or, some of what I thought was a little bit harsh on credibility. I think reduced forward guidance is not terribly intimidating to market participants. So I don't really think, can we get more from the Fed in terms of the metrics they're looking at, in terms of the structure of what is going to be important to them going forward? I think so. And I think we'll get more details around that. Listen, Annie, I think we're getting a lot of supply of product. You're pushing real rates up because you're getting a financial transmission that is historic in terms of whether it's fiscal supply that's coming from not just U.S., but obviously, pressures on whether it's UK, Japan, plus the amazing amount of supply we're getting into the credit markets. So I think it's more that than it is anything else. And like y'all have said, I mean, we still have some stickier inflation that is keeping these rates up. So anyway, those are where I would put what's the influences.
Hey, Rick, just super quickly, because we're about to talk to our tech reporter, Ed Lolo, about all the AI debt coming in, and we talked about it just a moment ago. You talked about what it does to the IG market. Do you think it changes the attractiveness or the pressure on the Treasury market at all, getting all that supply from the AI hyperscalers?
I mean, whenever you push that much supply into the market, you think about there's a crowding out effect. I mean, listen, the U.S. Treasury is still the behemoth in terms of issuance, but you take what's coming in IG, asset backs on the back side of it through data center. So yeah, I just think we're getting a lot of supply, and all markets, including government bonds, are reflective of that.
Hey, Rick, we always appreciate your time, especially on a Jobs Friday. BlackRock's Rick Rieder.